Wait, what? I can do that? This is Eric Bell with Wait, What? Financial matters that matter per business and the people that own them. I'm fortunate today to have David Greenberg with me, who is a returning guest, has several episodes with us, and we're going to talk about businesses that do exporting specifically. David, can you give me some background on export tax benefits?
Yes, they've been around since the early 80s. They exist to incentivize U.S. companies to build, manufacture, or grow products in the U.S. and export them. Because obviously the more that the U.S. exports, the better it is for our economy. And so Congress enacted all kinds of rules related to what we call domestic international sales corporations, which if you set one up and you sell anything that's made in the U.S. outside of the U.S., you can effectively get a deduction that's equal to 50% of your foreign profit. So if you have $100 million in foreign sales and the profits from that is $5 million, they're using a domestic international sales corporation. It allows you to effectively get a $2.5 million tax deduction for those sales, and it's completely a paper company.
Wow.
And Congress has authorized and okayed it and wants it just to incentivize people to export.
So are a lot of exporters taking advantage of this?
All the big companies are, all the Fortune 50, Fortune 500 companies are, but a lot of the, medium size from, 500 million to 10 million don't know about this strategy.
Okay.
And the other thing they're not familiar with is there's a rule that says 50% of your content has to be U.S. sourced. And so a lot of people think if they make product in China, bring it back to the U.S., and then re-export it, it's not going to qualify. But if they do something in the U.S., including increasing the price that it's sold for, you get to count that towards the 50% test, and those products would qualify for the Domestic International Sales Corporation strategy.
So I know your company, Dave, and the people that work for you are on top of this big time. This is kind of an out-of-the-box, something that it's a specialty. It's not something that every accountant or tax attorney knows about.
That's correct.
And I wanted to ask you, what is an interest charged domestic international sales corporation?
It's essentially an authorized paper company by the IRS where you flow your foreign sales through it. You can either have the shareholders own this domestic international sales corp, or you can have the company actually own it. And what it does essentially is it charges a commission equal to half the foreign profits for any foreign sales that are made. And so you get a deduction at the corporate level for the commission, and the DISC recognizes the commission as income, but it doesn't have to pay any taxes on it.
Can you give me some numbers how that would work?
Yeah. So I'll go back to the other example. If you have $100 million in foreign sales and $5 million in net profit, you'd have a $2.5 million commission that gets paid to the Domestic International Sales Corporation. So you get a deduction at the corporate level for $2.5 million. The DISC recognizes $2.5 million of income, but because it's related to export sales, it's not subjected to income tax.
And this kind of replaced some of the things that were repealed in 2001 and 2006.
It's always been there, but it was left after there was something else called a Foreign Sales Corporation, which essentially worked the same way, but they eliminated that because of issues with our trading partners. They said it was a subsidy that we were giving to the U.S. companies that was unfair trade advantage.
Can you give us some insight or uplift in terms of how the structure itself works?
Yeah, relatively straightforward. The company sets up what's called a Domestic International Sales Corporation.
Through you?
It's just a regular corporation.
All
you
right.
can go to Nevada and you can create a corporation.
Okay.
And it's either owned by the company or by the shareholders or by the shareholders' kids. And then you have some commission agreements between the company and the Domestic International Sales Corp. It keeps books and records, which are basically equal to the commissions that are payable to the DISC. And then you can start, you get your deductions. The DISC accumulates income, and it can loan the money back to the corporation. It's called a producer loan. So all the money basically stays inside the U.S. company, and the DISC just has receivables and payables on its books.
Now, I was reading something about this 4% gross receipt method and the 50-50 combined taxable income method. What's the difference?
It's a way of computing your commission. You can either do it based on 4% of your gross receipts and say that's the commission, or you can take 50% of the profit. You usually come out better off taking 50% of the net profit.
Any final questions or conclusions, David, that you can think of before we end this episode?
Well, all I can say is if your company is exporting profit and has more than a product and has more than, say, $1 million in exports, and those exports are profitable, and we can help in computing what that profit is, there's some ways to improve the profitability of these companies using the code provisions to your advantage. They should take a look at it.
This is Eric Bell. Please get hold of me if you want to talk to David regarding this strategy at eb@wait-what.biz. Thank you for being with us, David.
Thank you. I appreciate it.